At the moment, as expected, the European Central Bank has cut the benchmark interest rate to 7.75%. Remember, it's currently at 1%, and it was widely expected that 0.25% will be cut by the European Central Bank, and it has been done. It also cuts the deposit rate to 0 from 0.25%. That's also an important point. Cuts benchmark interest rate by 0.25% to 0.75%. At the moment, currently it was at 1%, and cuts deposit rate to 0 from 0.25%. Remember, all these measures are being taken by the European Central Bank to infuse liquidity into the European nations, the banks of the European nations. Remember, there are 17 banks in the Eurozone, and they have been crippled at the moment because of the economic scenario and with heavy debt conditions. And that's one of the reasons why the EU summit in Brussels also had come to a consensus and was putting a lot of pressure on the European Central Bank to cut the rates. And that's exactly what the European Central Bank has done. Two important rates being tinkered at the moment to infuse more liquidity into the Eurozone that we are seeing at the moment. 0.75% is the kind of interest rates that we have got. And let's take a look at the European markets. How have they been reacting to this particular important piece of news? Because remember, they were flat to positive earlier in anticipation of a rate cut. In fact, most of the analysts said and market men said that the European banks, European markets had actually factored in this move. Let's go straight to George Cherian for more perspective on that. George, thanks so much for joining in. So as expected, a 0.25% cut. How is it going to impact the entire Eurozone region?
Right. So, Nisha, the 0.25% cut in the lending rate, that the rate which has been cut from 1 to 0.75%, is something that the market had priced in. The additional factor that you've seen come in is the deposit rate, which most people expected would be left untouched at 0.25%. That's been cut to 0%. So that, in some part, is expected to spur banks into lending more in the interbank lending market, and the expectation is that you'd possibly see the Euribor rate come off current levels. Simply because banks have no incentive now to park excess cash with the European Central Bank. But I think we've got Peter Dixon with us. He joins us on the show from London. Peter, how would you read into this, the lending rate cut by a quarter point, but more importantly, the deposit rate cut by a quarter point as well?
Yeah, I mean, as you rightly pointed out, I mean, this is an attempt to force banks to lend and not park the money. But I think in a sense that's missing the point, because the balance sheets of banks are so battered that they're not really in any position to want to lend, and I think it's really symbolic. I don't imagine it's going to have a major impact at the margin, but I think what the ECB is telling the market that, hey, look, we're doing everything we can. We're trying to forestall any criticism that we're not being active enough. So let's read it as a signal. But I'm very sceptical that it will have the benefits which many people expect it to have.
Right, but Peter, the big concern that everyone we've spoken to has expressed is whether indeed these rate cuts that we've seen today will translate into lending rate cuts by banks themselves. Now, the concern is that, unless the real sector sees any benefits of lower interest rates, you aren't really going to see the situation in Europe improve.
No, I think you're absolutely right. I mean, you've got to bear in mind, of course, that the problem in the Eurozone now is far beyond anything which the ECB can fix by interest rate cuts in any case. But you're absolutely right. I mean, I think that banks are so desperate to try and stay afloat in this environment that they're certainly not going to pass on the full extent of that 25 basis point rate cut to their clients. And I think to that extent, your skepticism, if I can read that into your question, is fully justified.
Right. Now, Peter, there was some expectation, even if only a minority of market participants were expecting this, that you'd possibly see the European Central Bank announce a third round of LTROs. There was one section of the market that believed that the ECB had sort of got its back against the wall, that it had little choice but to come out with an LTRO. There was another section of the market that believed that the ECB ought not to do anything on the lines of an LTRO. Of course, now we do not have an LTRO, but do you believe an LTRO may have helped?
Yeah, I think it's probably going to give much more help to the banking system than marginal rate cuts. And don't forget that the ECB could well come back into the market in the course of the next few months if things deteriorate and give us more cash via this route. So just because they haven't acted today, don't expect that that's the end of the story, because I think there's an awful lot of scope for further action, particularly if they offer very long maturity funds, which will certainly go a long way to helping the banking sector.
Sure. So, but Peter, even then, on the one hand, you've got this whole expectation of an LTRO and, the expectation that LTROs will come. On the other hand, you've got European banks with still very large balance sheets which they need to deleverage. And, just to take the example of BNP Paribas, its balance sheet size is almost the size of the French economy. On the one hand, you've got a deleveraging requirement. On the other hand, you've got the central bank loading these banks with cash in the hope that, the liquidity concerns will ease and that they will on-lend to the real sector. Isn't that a bit of a tricky situation that the system faces?
It's more than a tricky situation. I mean, basically, it's a major paradox. And I think policymakers and analysts like myself have become increasingly aware of this paradox over the course of the last couple of years. I mean, I think what it tells you ultimately is that, balance sheets are far too big. They will have to be reduced. And therefore, I think that the deleveraging will take precedence over the lending requirements over the course of the next couple of years. And I think the net result of this will be that monetary policy has effectively lost effectiveness. And irrespective of what central banks do from here on in, I think that all we can do is wait until banks' balance sheets are repaired or put in better state, perhaps better to say, or at least have been reduced to some extent before they're going to be in a position to start lending again.
Sure, but Peter, just when we look a little closer at the ECB action we've seen today, do you believe it may have been a better idea for the ECB to hold the benchmark rate, the lending rate at 1%, and possibly cut the deposit rate to 0%, which then would have changed things in the interbank market and possibly taken interest rates lower? Do you believe a deposit rate cut may have been more effective than a lending rate cut?
Yeah, I think there's some marginal benefits to pursuing that line of thought, but I think the major problem now is that interest rates are at such low levels that we're talking really about quarter point rate cut here or there. It doesn't really make a big difference in the grand scheme of things, and any benefit that we get would be marginal. I think going back to one of your previous questions, what is the best way forward from here? It's basically to swamp the markets with liquidity, and the LTROs are probably going to be even more effective than cutting the deposit rate.
And Peter, just a quick word on the marginal lending rate having been cut to 1.5%. How effective do you believe this is going to be for banks?
Not hugely significant at this stage. I mean, banks aren't, banks are trying all sorts of other ways to find the liquidity that they need. They can effectively do all sorts of other things. They can engage in various repo transactions. The marginal lending rate these days is almost irrelevant. And as I said, I think cutting rates by quarter points here or there isn't going to make any difference at all.
Peter Dixon, many thanks for coming in on the show and giving us your perspective on the ECB rate action we've seen. So we've had a 0.25 percentage point cut on the benchmark lending rate of the European Central Bank from 1% to 0.75%. The deposit rate cut from 0.25% to 0%. The thinking at the European Central Bank being that banks will now be forced to lend more in the interbank lending market. The Euribor rate, effectively the 1-week rate presently, is at I think about 0.31%. That should come off further from current levels. The 6-month rate is at about 0.9%. All these rates should come off and effectively lower interest rates in the system. If the deposit rate goes to 0%, it leaves banks with very little incentive to park excess cash with the European Central Bank, and that in turn will bring rates down.